Back in March 2020, the world was shutting down. Panic was everywhere. And yet the markets bottomed on the exact same day the lockdowns began. It wasn't because things were looking better. It was because markets had already priced in the worst. That's what markets do. They move ahead of the headlines. They sniff out when the fear has peaked and position for what comes next. And if the pattern holds, then what we're seeing right now with Bitcoin, gold, and even equities suggests something really big has probably shifted again. Bitcoin has just broken above 93,000. Gold, again, another all-time high of $3,500. And the S&P 500 just posted a 2.5% rally. All while trust in the dollar, the Fed, and US leadership continues to erode. We're not just watching asset prices climb, we're watching capital evacuate. The world is front-running a breakdown in the system, and Bitcoin, it's leading the charge. For years, Bitcoin moved in lockstep with tech stocks. When the Nasdaq fell, Bitcoin fell even harder. But that correlation, it's likely gone, and it might not be coming back ever.
Probably didn't look at Bitcoin. What do you make of the way that this has been trading? It's decoupled, obviously, from the Nasdaq, which was a trend for a while. How do you see it?
Something that people were looking for all month, because if you go back to earlier this month, it really was trading in line with stocks. It just was not seeing the big, pops and drops that one, we're used to seeing out of Bitcoin. And two, it is outperforming the S&P. It has not really caught up with gold, the, leading safe haven. But I think you are seeing evidence, not just, I think that the obvious and easy narrative would be that we're talking about Fed independence today. So Bitcoin is kind of acting as that hedge against political uncertainty. But I also think that it's not just enthusiasm, it's also exhaustion. You're seeing people, investors wanting to, get back into risk, but just maybe not the type of risk that's tied to earnings or Fed policy.
In recent weeks, we've seen Bitcoin rise while equities wobbled. And even during sharp intraday drops in the S&P 500, Bitcoin kept climbing. That's not a coincidence. That's a signal. The data is backing it up. The Pearson correlation between Bitcoin and equities has collapsed, while its correlation with gold is spiking and approaching levels not seen since early pandemic stress. Even intraday Bitcoin is breaking away. Charts show Bitcoin rising while stocks fade, a clear sign that the market no longer sees it as a tech trade, but as a macro hedge. We've seen Bitcoin rally while ETF flows remained negative, which means this is not retail FOMOing in, although you guys should be, in my opinion, not financial advice, right? But this is large players positioning early. The short liquidation rate across major exchanges just hit over 90%, indicating massive positioning was caught offside. And while traders scramble to unwind risk, Bitcoin is breaking new ground. It's not just that Bitcoin is moving higher, it's who's moving it and what they're preparing for. If you blinked, you missed the fastest political reversal in recent memory. In the span of just 2 weeks, Trump went from calling Jerome Powell a major loser and floating his removal to reassuring the markets he had no intention of firing the Fed chair. The shift came fast and it came loud. Markets heard it clearly. We've now got headlines like Trump will be very supportive of China, tariffs will come down substantially, and trade agreements are close with Japan and India. The deals themselves, they're vague, more like placeholders than policy for now. But that doesn't matter to the market. The tone has changed, and that tone signals an attempt to calm things down before confidence slips any further. The real turning point came when Treasury Secretary Bessent told JP Morgan clients behind closed doors that the China tariff war was unsustainable. Bloomberg reported the leak midday, and markets took off. The S&P jumped 2.5%, tech surged, and Bitcoin, well, it pushed even higher. And ETH, good old sleepy ETH, rallied super hard. Capital was waiting for any signal of de-escalation, and this was it. The political pivot may have helped spark a short-term boost to risk assets. But by that point, the US dollar had already been falling, while the S&P 500 rebounded and Bitcoin surged past $93,000, the more important story was playing out in the background. Confidence in the dollar was quietly unraveling. Investors weren't simply reacting to Powell, Trump, or tariffs. They were responding to deeper concern that the foundations of US financial leadership were becoming unstable, and the dollar was no longer behaving like the global anchor that it once was. The US dollar index, or the DXY, just recorded its largest monthly drop since the launch of QE1 in 2008, a watershed moment that kicked off the era of modern liquidity. The technicals only reinforced the message. The dollar is now at its most oversold level since the global financial crisis, with almost no historical precedents outside systemic shocks. Currency markets are no longer behaving according to traditional rate cycles or yield differentials. Hedge funds have been steadily shorting the dollar since April, when political noise around Jerome Powell's job security began to escalate. Those trades gained momentum after Kevin Hassett publicly floated the idea of replacing Powell, prompting a shift in how global investors interpret the stability of US monetary policy. At the same time, foreign holders of US assets are starting to reduce exposure. Markets are beginning to show global investors no longer treat the dollar as a reliable defensive asset. When volatility rises, the greenback is no longer strengthening. That change in behavior is pushing capital elsewhere, not just into emerging markets, but into alternative stores of value like gold and Bitcoin. Other major currencies are rallying for reasons that defy conventional logic. The euro is gaining even as the ECB cuts rates. The yen, it's bouncing despite efforts by Japanese authorities to weaken it. These moves reflect a broader capital rotation away from the dollar, driven by concerns over policy coordination, fiscal sustainability, and executive overreach in the US. Treasury and Federal Reserve investors are seeking shelter in places that offer clarity, and the US isn't offering much. But since recent policy guidance was delivered behind closed doors at JP Morgan's Investor Summit, rather than through a formal Treasury statement, that quiet shift away from institutional transparency only added to the impression that US leadership is improvising rather than executing with a plan. With capital flowing into gold, the euro, the yen, and Bitcoin all at once, a new consensus is emerging. The traditional institutions that once anchored the global financial system no longer command the same confidence. And that erosion is showing up where it always does first, in the currency markets. As confidence erodes and currencies slip, capital doesn't retreat, it repositions. The clear signal of where it's headed comes from global liquidity. When global money supply expands, risk assets rise. It's literally that simple. And right now, the world is quietly stepping into a new liquidity cycle. Global M2, a key measure of money supply, it's accelerating again. Historically, this has been one of the most reliable indicators for asset prices. Bitcoin has already begun to move, and the data shows it outperforms when liquidity ramps up. China is leading the charge. The People's Bank have injected over 3.2 trillion RMB, that's around $440 billion, into the system since December. Alongside that, Beijing has formally shifted its policy stance from prudent to moderately loose, opening the door to further monetary easing throughout 2025. And Japan is preparing to intervene in the currency market as well, with the potential goal of weakening the yen to support exports and reactivate the carry trade. If successful, this move could drive Japanese capital back into US treasuries and equities, creating a fresh source of cross-border liquidity. In the US, policymakers understand the benefit of softening dollar. A weaker dollar lowers the cost of debt service, provides support for asset prices, and makes it easier to manage trade imbalances without further escalating tensions. Across major economies, the direction of policy is converging. As Andreas Steno noted, all roads lead to weak USD unless we get a liquidity crisis, which currently is nowhere to be seen. The Treasury, the Fed, and their global counterparts may not be moving in perfect sync, but they're all reacting to the same pressure. They need to stabilize the system and support credit markets without triggering panic. This is the dynamic that matters most for market direction. As liquidity flows, investment capital follows. Bitcoin, as the most responsive asset to liquidity expansion, is already signaling the next leg up. Markets are being primed by monetary force instead of hype. For years, institutional adoption of Bitcoin was more of a narrative than an actual reality. It was a slide in a hedge fund pitch deck, not a real line item on a balance sheet. But now, you know that's changed. The shift is no longer speculative. It's structural and it's accelerating. This week, Standard Chartered and Deutsche Bank both announced plans to expand their crypto operations into the US. These are legacy institutions making long-term bets on digital assets as part of their core financial system. This is radically shifting everything. That trend is gaining speed because the regulatory environment is beginning to open up. Trump's executive order on digital assets, combined with the confirmation of pro-crypto SEC Chair Paul Atkins, has triggered a wave of institutional repositioning. Atkins has consistently pushed for a framework that protects investors without killing innovation. And I must say, this is a little bit surreal for me right now because on the 28th, we actually have a meeting with the SEC. And for me, as a US citizen who fled the US from fear of persecution for operating crypto companies, to finally coming back and having an opportunity to sit at the table with the SEC and talk about the things that we're building, Paid Network, for example, and Commonwealth, is absolutely mind-blowing to me. And it's exciting, and I guess there's no words for me to describe how I feel right now with this pro-crypto administration and the pro-crypto SEC. It's, as a builder myself and as a VC, as an American, I just really can't even tell you how excited I am to see where this goes. And with Paul Atkins now leading the SEC, the path is being cleared for long-awaited clarity on altcoins and potentially fast-tracking more crypto ETFs. But the biggest signal of this inflection point comes from a multi-billion-dollar move that's flown largely under the radar. Wall Street giant Cantor Fitzgerald is building a Bitcoin acquisition vehicle called 21 Capital. The son of Trump's Commerce Secretary Howard Lutnick, Brandon Lutnick, will be leading the initiative. It's backed by Tether, SoftBank, and Bitfinex. The goal is to replicate the MicroStrategy model, but bigger. Which is nuts. Which is nuts. Are you listening to this? But bigger and with full institutional alignment. This is sophisticated capital formation, a next level of Bitcoin demand. A special purpose acquisition company has already raised $200 million in cash and is preparing to add another $550 million through a bond and private equity deal. Once finalized, 21 Capital will hold over $3 billion in Bitcoin and become a publicly traded proxy for institutional exposure to digital assets. Are you listening and paying attention? These moves aren't happening in a vacuum. They're happening because the policy narrative has changed. Where Gensler used regulation as a weapon, Atkins is positioning the SEC as a platform for financial modernization. That opens the door for Wall Street, private equity, and sovereign capital to enter the space without fear of arbitrary enforcement. And when that capital moves, price doesn't just climb, the floor gets permanently raised. Right? Because these people are coming in buying Bitcoin for the long term. This is not short-term speculation. Markets don't wait for confirmation. By the time the headlines catch up, capital has already moved. What we're witnessing now is a deep, coordinated repositioning across currencies, asset classes, and core structures of the global financial system. The dollar, it continues to weaken. Confidence in institutional leadership, it's eroding. Meanwhile, global liquidity is quietly rising through coordinated action across border flows. Bitcoin is leading that shift, as it often does at the start of a new macro cycle. Major institutions are entering the space. Sovereign players are quietly preparing, and policymakers are changing course. Not because they've regained control, but because mounting pressure has left them with no choice. This is what the people are asking for. This moment, right now, reflects a collective reassessment of what financial resilience truly requires. Bitcoin, gold, and other hard assets are being revalued in real time. They are being chosen as safeguards against instability and geopolitical risks. They are no longer at the beginning of a new narrative. That moment has already passed. What comes next is a transition from soft promises to hard assets, from monetary improvisation to monetary certainty. Those who recognize a shift early will be positioned for what comes after. Those who wait may find that window has already closed. Ladies and gentlemen, thank you for watching. Make sure to like and subscribe. Until next time, stay sharp and stack sats. See ya.